The market looks unstoppable right now, but that's exactly when we need to be most careful. In this video, I'm covering the mental aspect of trading. The market will try and trick us. So we've got to stay logical when others panic. That's what we're covering in this video. I'm going to show you how to protect your portfolio utilizing hedges, and when that 10 to 15 or more correction comes, we're going to be able to profit and pounce and make a lot of money at that time. But right now, the market's at all-time highs, so we've got to be careful. Be sure and watch all the way to the end. I'm going to show you the live trades and how I'm hedging, and make sure to like and subscribe, and let's jump into it. Let's start off and do a macro reality check. So we'll look at the S&P 500 charts. The charts don't lie. Now, right now, we're sitting at the upper edge of the range, the same zone where previous rallies have stalled before major pullbacks. The Shiller PE ratio is hovering near historic highs, signaling the stocks are priced for perfection. The Buffett indicator, which compares total market value to GDP, is flashing red as well, meaning the market is worth far more than the economy it's supposed to reflect. And here's the key. Good earnings aren't going to push the stocks that much higher, and they're expected to be good this quarter, and it's just starting earnings season. So we're going to have good numbers, but with the stock prices already at highs, how much further can they go? That's the real question. Now, AI is huge, and it's going to drive the future, no doubt about it. But right now, there's extreme AI mania, and there's some political wild cards as well. Market sentiment right now is being driven almost entirely by AI. Every headline, every earnings call, every dip, it all comes back to whether investors still believe AI will keep fueling the next leg higher. The hype is massive. Stocks like Palantir, Tesla, Oklo move billions in market cap on single AI-related comments. But the excitement cuts both ways. When sentiment flips, fear spreads just as fast, and those same stocks can fall 10 to 20% in just a few days. And that volatility doesn't exist in a vacuum. Political headlines, from Trump's trade policies to tensions in China, Russia, and the Middle East, act as instant shockwaves that can swing markets either direction overnight. AI is absolutely real and transformative, but even the most revolutionary sectors can form bubbles before finding their true value. All right, so how do we protect and profit from a pullback? Well, when the market feels shaky, your edge comes from having a clear plan, not just reacting to fear. This is where options become powerful tools to both protect and profit. If you want stability, use static delta strategies, things like covered calls or protective puts that lock in defined risk and steady income. If you're more active, dynamic delta hedging lets you adjust exposure as the market moves, keeping you flexible while limiting downside. Now, should you go to cash or hedge? Honestly, both completely make sense. I like to raise some cash for buying power, but also layer in some hedges on key positions. That way, I stay invested but protected. All right, so how do we look at stock selection in a market like this when we're at the highs, historical highs? Well, there's still deals to be made, believe it or not, and good value on great stocks. So we only want to be in the best of the best at this point. So companies with real earnings power, strong cash flow, and balance sheets that can handle volatility. Think of names like Amazon, which I view as one of the lowest risk growth plays, along with AMD and Meta. All great plays right now, all leaders with proven business models driving the AI revolution. When it comes to adding positions, DCA, dollar cost average in smartly. Don't chase breakouts at the highs. Instead, scale in near 52-week support zones or long-term trendline levels where risk to reward makes the most sense. The goal isn't to own everything, it's to concentrate on strength so you can stay invested confidently whether the market pulls back or pushes higher. All right, let's dig in a little bit more to the mental game and the mindset so that we are ready when there is a 10, 15, 20% pullback. There's a clear mindset that separates investors from traders and winners from everyone else. A correction isn't something to fear. It's the reset that creates real opportunity. When prices finally come back to earth, that's when long-term positions can be built at true value and the big gains are made. As we approach year-end, keep in mind there's tax loss harvesting. So what that is it's going through your portfolio, and if you've had big gains on stocks and you want to take some of those off the table, this is the time of the year when a lot of people do that. Funds and investors are selling their losers as well to offset gains. It often spikes volatility in November and December, shaking weak hands right before markets stabilize. So stay focused. This is when fortunes are made, not by guessing the bottom, but by staying mentally sharp, disciplined, and ready to act when everyone else hesitates. All right, let's jump on the trading platform right now, and I'll show you a couple of trades that I have on that are strong positions. All right, guys, here we are on the Tasty Trade trading platform, my favorite for trading options. And there's a link down below. Benefits if you go through my link. It's super intuitive, and check it out. All right, I'm going to show you two trades right now that we've got on. The first one, Meta. Meta is a beast right now. You can look at the 1-year chart. What I want to show you, you can go right here, research news. We can go to financials. We can click on annual. And you can see the income statement, revenues increasing, net income increasing, balance sheet assets increasing, liabilities in check. We can go to ratios right here, 81%, 82% gross margins. So unbelievable income statement and balance sheet, tons of cash, super strong company. I actually do my numbers. These are the numbers that I have for Meta and my targets. If you put in the 12-month trailing revenue and 12-month trailing net income, forward PE of 30, very conservative for a stock growing like Meta's growing. I've got 17% per year conservative growth. They're going to hit that. 20% net income growth, and that puts the 1-year stock price at 1,009. And right now, we are trading in the 700 range. So we're at 740 right now. So this is a no-brainer, solid stock that even though we're at the top of the market, I'm very comfortable in owning. This is my favorite play right now. So I've got one poor man covered call on here. So I've got a deep in the money leaps at 700, and then I've sold a call against it. And then I've got a put credit spread as well that doesn't require as much capital. So two great trades right now for Meta. If we're going to do the poor man's covered call, we can go out to September. I like to go about a year out. So this is 330 days. And what I would do is I'd buy the in the money call. So I'd probably go, around 720, $123. And click on that. I'm gonna click on the buy. Calls are on the left, puts are on the right. And we can go to the center. $122 per share. One contract controls 100 shares. So that's 122 times 100 is $12,225. But here's the thing. To own 100 shares of Meta, it would be $741 times 100. It'd be 74 grand. So much less at 12 grand. But here's the thing. We're going to sell a call against it at the same time. But before we do that, let me show you curve mode. You can see as the stock price goes up, just like owning the stock, we make money. If it gets up to this 1,000 price, we make 20 grand if it gets up to 1,049, which is where it should be. So great way to make money in Meta. And then what we can do is we can go to the table mode, close this up, and then we can open up. I would go right now. I like to go 30 to 45 days to expiration, but we're already at 29. So I'm going to go out to December, 57 days, open that up, and then I'm going to sell a call against it. So we bought the leaps call option, and now we're going to sell a out of the money call against it. So let's look about the 25 delta. We can go right here to the 830 and sell the 1490. And that is very conservative. I don't think it's going to hit that. We could even go to the 810, anywhere in this range, 25 to 30 delta. But okay, just for the sake of it, let's go to the 25 delta, $1,500. We can collect that every single month. And you can see as soon as we click on that to sell it, our price goes down by that $1,500. And now we're at 107. So it's now it's a $10,000 cost to place this trade. So that's the benefit. We can collect $1,500 a month every month for 12 months. That pays off the cost of this leaps option, and then we control 100 shares of stock for free. Basically, that's the way I look at it. But we hit review and send and place the trade. All right, one other trade that I'm using as a hedge right now is the Qs. So I did a video on this. I'll link it down below. Actually, it will show, I believe, at the end of this video. But check that one out. And this is how I'm hedging right now, the Qs and what we can do. I did a full video outlining this strategy. But you're basically renting a hedge. So as the market, when there is that dip, we've always got a hedge on and we're always going to profit. So that, and we can collect income at the same time. So it's similar to the poor man's covered call, but this is a poor man's covered put, and we're not going as far out. So I like to go 85 days out. So I would go right here out to January. You could see I had 2 on, but I would go January, 85 days to expiration. And then I would go in the money on the put. I would go right here to the 615, click on the buy, and then just like the poor man's covered call, this time it's in the opposite direction. So we profit as the stock price moves down. So if there's a big drop in the market, this makes money. You can see our P&L expiration at right here at 400 is 25 grand that we would make. But the cost, only $23.88 times 100 shares. That's $2,388. So we could place that trade right now. But what I like to do is go ahead and close that up, and then I'll sell. Again, I'd like to go 30 to 45 days, but we're at 29 right now. So I would open up the December, and then what I'm going to do is sell a put against it. So we could go all the way down here to like the 20 delta, 18 delta. We can go to 560. So all the way down to 560. And we can click on the sell and collect $600. That brings our cost down by $600. We can do this every month and roll and collect that $600 a month to fund part of the cost of the protection of the long put option. So with this, we hit review and send and place the trade. And the way that we manage this, at about 15 to 20 days, I roll the short put out. And then on the 90 days, on the long put, once it gets down to around 30 days, I want to push that back out to 90 days. So I'll close it, and then what I'll do is I will buy another one 90 days out at that time. So it's just kind of a way to keep a hedge on long term. And check out the video that covers the full details of the hedge. So you hit review and send and place the trade. All right, guys, at the end of the day, the charts don't lie. If we're at historical highs like we are right now, we're probably due for a pullback, 10, 15, 20%. I don't think there's going to be a crash, but there could be a good pullback, and there will be. It's just a matter of when. So, hey, leave your comments down below. Let me know, are you hedging right now? What stocks do you like? And be sure and like and subscribe down below so you're informed of the upcoming videos, and check out the free options workshop in the link below. There's also a paid course if you want to level up your game. If you like this video, watch this next one.